The pursuit of market-beating returns demands more than simple balance sheet analysis. It requires a deep understanding of human behavior and global macroeconomic forces. Leon Levy, the intellectual giant who co-founded Oppenheimer and Company and later the legendary hedge fund Odyssey Partners, mastered this fusion, creating a unique framework known as behavioral macro investing. His career spanned volatile decades from the inflation shocks of the 1970s to the dot-com bubble of the late 1990s, providing him with unparalleled experience in navigating complex market cycles. Levy's methods were not about finding cheap stocks based on static metrics. They were about identifying structural mispricing caused by collective emotional errors and governmental policy shifts. The proof of this concept lies in the sustained, exceptional performance of the funds Levy managed and advised throughout his career. While specific numbers fluctuate based on the measurement period, annualized returns consistently exceeded the Standard & Poor's 500 benchmark by significant margins over multi-decade periods. This establishes a factual, data-driven basis for the claim that his methods consistently beat the market across various economic regimes. This outperformance was achieved through disciplined contrarianism, often placing large bets against the prevailing wisdom when underlying data suggested an impending reversal. He fundamentally believed that superior investing stemmed from intellectual independence, not conformity to consensus forecasts. The 5 golden rules derived from Levy's philosophy, documented primarily in his memoirs and professional writings, synthesize this dynamic approach. These rules move far beyond the static calculations favored by traditional value investors like Benjamin Graham, focusing instead on market timing driven by psychological indicators. They form an analytical framework designed to time the market effectively and identify value where psychological forces have created massive distortions. Understanding these 5 pillars is essential for any serious investor seeking to transform market noise into actionable, profitable strategy. Before we dive deeper into the first essential rule, which concerns market narratives, we have a quick but crucial request. Please take a moment right now to subscribe to the channel and leave a comment below, even just a single word or a thought on behavioral finance. This small action helps the algorithm immensely, ensuring this vital content reaches more serious investors like you. It confirms that these deep dives into legendary financial minds are truly valuable and worth the significant effort required to produce them. Leon Levy argued that the greatest investment errors are born when a compelling story overrides objective financial reality. He termed this the market narrative, a dominant, emotionally charged consensus that dictates asset prices far more effectively than quarterly earnings reports. This narrative is rarely subtle. It is amplified by the media, embraced by retail investors, and often supported by institutional momentum traders who fear missing out on the trend. The core concept of Rule 1 is recognizing that when a story becomes too perfect, the underlying value proposition has likely evaporated. This phenomenon was dramatically visible during the late 1990s when the new economy narrative suggested that traditional valuation metrics were obsolete for technology companies. Companies with zero earnings and massive debt were awarded astronomical market capitalizations simply because they fit the prevailing exciting story of perpetual technological disruption. Levy taught that the investor must train themselves to hear the narrative but look past it, focusing instead on the inevitable mathematical limits of growth and profitability. The market story acts as a powerful psychological veil, blinding participants to the simple fact that no company can grow its revenues or profits to infinity. Identifying a saturated narrative requires analyzing market consensus and the level of emotional saturation present in public discourse. Levy looked for universal acceptance. When analysts, taxi drivers, and cable news pundits all agree on the future direction of a specific sector, the narrative is dangerously mature. He meticulously tracked media coverage, noting when skepticism disappeared entirely and was replaced solely by enthusiastic forecasts of perpetual upside. This widespread, uncritical adoption signals that every potential buyer has already entered the market, leaving no marginal demand to sustain prices. The key indicator is the displacement of fundamental analysis by anecdotal enthusiasm and future projections devoid of current cash flow support. When companies are valued based on revenues projected 5 years out, and current losses are dismissed as merely investments, the narrative has achieved critical mass. This consensus is powerful because it is self-reinforcing, punishing early skeptics and rewarding late adopters until the system becomes structurally unstable. Levy sought investment situations where the narrative had become so emotionally compelling that it actively discouraged any form of rational dissent. The data-driven analysis confirms that widely believed narratives inevitably lead to unsustainable valuations, guaranteeing future disappointment. These valuations incorporate perfect execution, limitless growth, and zero external threats, a scenario that reality almost never delivers. When a company trades at 100 times earnings, the slightest deviation from perfection, a minor earnings miss or an unexpected rise in interest rates, can trigger a catastrophic rapid revaluation. This is the valuation trap. The price already reflects the maximum possible success, leaving only room for failure and decline. Levy's demand was simple: bet against the compelling story, often by seeking out assets in the most hated, non-narrative-driven sectors. This requires immense psychological fortitude because the investor is essentially fighting the collective euphoria and momentum of the entire market. He looked for assets or sectors that were profoundly disliked, ignored, or actively ridiculed because they stood outside the dominant, fashionable narrative. The true value investor, according to Levy, must be a skeptical historian, recognizing that today's revolutionary story is often tomorrow's forgotten folly. The power of a narrative stems from its ability to simplify complexity into a single, emotionally satisfying concept that justifies high prices. This simplification allows large pools of capital to move in unison, creating extraordinary momentum that temporarily overwhelms the fundamentals of gravity. Levy was fascinated by how human psychology demanded certainty and optimism, especially during prolonged periods of prosperity and easy money. He observed that the longer a narrative persists, the more deeply embedded it becomes in corporate strategy and governmental policy, making the eventual reversal even more violent and damaging. A crucial part of Rule 1 is understanding the difference between a genuine structural change and a temporary psychological fad layered on top of that change. While technological advancement certainly occurred in the 1990s, the narrative that this time is different regarding valuation principles was purely psychological and ultimately demonstrably false. Levy's methodology required separating the factual technological shift from the emotional pricing bubble that was layered on top of it. He sought investments where the cold, hard facts directly contradicted the prevailing market narrative, establishing the essential foundation for a contrarian position. The inevitable collapse of a market narrative provides the greatest opportunity for disciplined contrarian investors who remained patient and liquid. The moment the story breaks, the emotional justification for the inflated prices vanishes instantly, leading to rapid repricing toward fundamental value. This recognition that market prices are temporary, volatile expressions of collective emotion, not permanent reflections of intrinsic worth, is the intellectual starting point of Levy's entire systematic approach. Therefore, the first golden rule is not just about avoiding overvalued stocks. It is about actively seeking out assets priced by fear and ignoring assets priced purely by market fantasy. Rule 2 provides the crucial timing mechanism, defining the exact moment when psychological stress creates maximum opportunity, the selling climax. Levy understood that true value investing is impossible without effective timing, but his timing was based purely on observable behavioral indicators, not obscure technical charting patterns. The selling climax is not merely a slow, grinding decline. It is a rapid, violent, and emotional capitulation where investors, both retail and professional, abandon all hope and sell assets indiscriminately at any price. This specific moment marks the definitive transition from generalized fear to genuine, widespread panic, distinguishing it from the gradual decay seen in bear markets driven purely by economic fundamentals. Levy sought this moment because it guarantees the maximum number of forced sellers are clearing the market, effectively removing the overhang of potential supply. He believed that prices during a selling climax are functionally meaningless regarding intrinsic value, driven entirely by margin calls, rigid risk management mandates, and overwhelming psychological despair. This is the precise moment when intrinsic value and market price achieve their greatest, most profitable divergence. Analyzing the characteristics of a true selling climax requires close observation of several key behavioral and market indicators, starting with trading volume. First and foremost is extremely high trading volume, indicating mass distribution of shares from emotionally weak hands to financially strong, disciplined hands. This volume is often accompanied by sharp, highly volatile intraday price movements, characterized by massive gaps down, followed by brief, violent counter-rallies that immediately fail under renewed selling pressure. The defining psychological trait is widespread emotional panic, often fueled by sensational negative headlines, and institutional herd behavior amplified by leverage. Levy focused intensely on the quality of selling, noting when major institutional investors, who should be long-term, rational holders, begin dumping entire diversified portfolios regardless of individual company quality. This indiscriminate selling is the unmistakable hallmark of complete capitulation, where the goal shifts dramatically from maximizing profit to simply minimizing pain and exposure. He looked for evidence of retail investor despair, often reflected in surveys showing maximum bearish sentiment and media coverage declaring the structural end of prosperity and growth. These indicators are crucial proxies for the near depletion of the available supply of potential sellers. Buying during a true selling climax provides a statistically superior risk-reward profile compared to initiating positions in any other market environment. When prices have fallen far below replacement cost or book value due to panic, the potential downside is demonstrably limited, while the upside, fueled by inevitable mean reversion and recovery, is vast and asymmetric. Levy used specific historical examples such as deploying capital during the major crash days of October 1987 or during specific sector collapses to demonstrate this principle effectively. In these intense moments, quality assets were available at a fraction of their long-term economic worth, offering high potential returns. The statistical edge comes directly from the mean reversion principle. Extreme emotional deviations from fair value are always temporary aberrations, not permanent states. By purchasing assets when the risk of further selling is largely exhausted, the investor benefits almost immediately from the normalization of sentiment and the return of rational buyers. This approach requires precise observation and timing, but more importantly, it requires the immense psychological strength to act decisively when every instinct and every headline screams caution and fear. Levy emphasized repeatedly that the best, most profitable buying opportunities feel the absolute worst to execute. Understanding the internal mechanics of capitulation is central to successfully implementing Rule 2. A selling climax typically involves a violent cascade effect, where initial fear triggers immediate margin calls, forcing more selling, which rapidly intensifies the existing fear and triggers yet more margin calls across the market. This negative feedback loop accelerates until the price drop achieves maximum velocity and volume simultaneously, indicating a clearing event. Levy taught his partners to closely monitor volatility indexes in futures markets, which often exaggerate the panic and provide clear, quantifiable signals of extreme systemic stress. The absence of positive market response is also a key behavioral indicator. During a climax, even genuinely good earnings reports or positive company news are typically ignored or misinterpreted as temporary anomalies. The market refuses to believe anything positive, signaling that pessimism and negative expectation have reached their peak saturation point. This emotional collective blindness creates the perfect temporary environment for the disciplined, contrarian investor to acquire quality assets at profoundly distressed prices. The selling climax is the necessary behavioral outcome of a previously overheated market narrative, linking back directly to Rule 1. It might seem highly counterintuitive, but buying during maximum panic is in fact a powerful form of active risk management according to Levy's framework. The risk of permanent capital loss is significantly lower than buying when prices are high. Even if the temporary volatility is extreme and frightening, Levy viewed volatility as a temporary inconvenience that creates opportunity, while dangerous overvaluation was considered a permanent threat to capital. By acting only during the climax, the investor minimizes the duration of the drawdown phase and maximizes the capture of the subsequent recovery rally. This rule effectively transforms market volatility from a systemic threat into a structured, profitable opportunity. Levy's third golden rule establishes his foundational belief in the primacy of the big picture, arguing that no investment decision, regardless of how strong the individual company fundamentals appear, can succeed without correctly understanding the global macroeconomic environment. The macro context, interest rates, structural inflation trends, central bank policy, and major geopolitical shifts, acts as the essential, overriding filter through which all individual company earnings must be viewed and discounted. He argued forcefully that even the best company cannot indefinitely swim against a massive tide of restrictive monetary policy or a structural economic collapse. This focus elevates macro analysis far above traditional micro-level stock picking, positioning Levy closer to the philosophy of George Soros than to the more micro-focused methodologies of Warren Buffett. He viewed stock markets as highly leveraged derivatives of the underlying global economy, meaning that systemic shifts always overpower individual corporate performance in the short to medium term. Therefore, the investor must first accurately forecast the direction and velocity of the macroeconomic tide before rationally deciding which individual sector or company boats to board. Ignoring the big picture is the investment equivalent of trying to buy a specific house without knowing the prevailing mortgage rates or the local employment forecast. Specific analysis of interest rates and central bank monetary policy was paramount in Levy's macro framework. He understood fundamentally that the cost of capital is the single greatest determinant of asset valuation across the entire spectrum, from long-term bonds to high-growth stocks. High restrictive interest rates aggressively discount future earnings, severely penalizing companies that require massive capital infusion and pushing valuations downward rapidly, regardless of individual company earnings growth. Conversely, periods of sustained low rates artificially inflate asset prices across the board by lowering the discount rate. Levy used sophisticated monetary policy forecasts to determine precisely which sectors or asset classes were fundamentally mispriced by the market's failure to anticipate central bank action. If he foresaw an imminent shift to tighter policy, he would divest strategically from long-duration, high-growth stocks and allocate massively toward assets that thrive in inflationary or high-rate environments, such as commodities, energy infrastructure, or short-term debt instruments. This proactive, data-driven positioning based on accurate rate forecasts was a hallmark of his successful macro bets, allowing him to position his portfolio months ahead of the consensus shift. Demonstrating how macro forecasting-informed portfolio structure is crucial to understanding the practical application of Rule 3. Levy's process began by analyzing global capital flows, fiscal deficits, and governmental actions, leading to large non-consensus bets on entire asset classes before focusing on specific equities. For instance, if he predicted a major sovereign debt crisis in Europe, he might take a massive leveraged position in a specific currency or buy protection on vulnerable bonds, using equities only as a secondary, highly selective allocation. This strategy ensured the portfolio was strategically optimized for the dominant systemic risk or opportunity identified through macro analysis. His allocation was necessarily dynamic, often leading to temporary periods where the overall portfolio held very little equity exposure, focusing instead on fixed income, currencies, or commodities that benefited from the macro environment. This differed sharply from traditional restrictive equity funds obligated by their mandate to remain fully invested in stocks at all times. Levy's macro lens allowed him to make massive strategic shifts, for example, moving from being heavily long technology in the mid-1990s to positioning for a massive structural commodity boom as inflationary pressures mounted aggressively in the early 2000s. The macro cycle dictated the precise weighting and composition of the entire investment portfolio. Rule 3 dictates that micro-level mispricing often arises directly from macro-level misunderstanding or miscalculation by the market consensus. For example, if the market universally believes inflation is merely transitory, while Levy's proprietary analysis suggests it is deeply structural and persistent, then companies priced for a low inflation environment are fundamentally and dangerously mispriced. Levy would then look for specific companies within inflation-protected sectors, like energy exploration or hard materials, whose valuations had yet to catch up to the impending macro reality. The accurate macro forecast provides the opportunity, and the micro stock selection provides the necessary leverage and specific vehicle for the bet. This approach requires mastering complex global economic data, including trade balances, fiscal deficits, complex commodity supply chains, and geopolitical tensions far beyond the scope of a typical fundamental stock analyst. Levy stressed that the world is a single, interconnected, highly leveraged system, and a major policy decision in Tokyo or a political shift in Europe could instantaneously change the valuation landscape in New York. The investor must therefore be a global economic historian and forecaster, not just a local stock picker, to apply this rule successfully and consistently. Leon Levy's fourth golden rule fundamentally redefined the concept of cash, arguing emphatically that holding significant cash reserves is a strategic investment position, not merely a passive lack of viable investment ideas. This perspective stands in direct opposition to the institutional pressure faced by most fund managers, who are severely penalized for underperforming when holding cash during a bull market phase. Levy viewed liquidity as the ultimate form of optionality, providing the essential flexibility required to navigate extreme market volatility and sudden crises. Cash provides robust psychological insurance against the urge to relentlessly chase rising speculative prices and physical preparedness for the inevitable sharp market correction or systemic crisis. He maintained that disciplined capital preservation during periods of market speculation is just as important and often more profitable than aggressive capital deployment during periods of distress. By maintaining a substantial cash buffer, the serious investor ensures they are never forced to make poor reactive decisions out of necessity or fear of missing out. Liquidity is the strategic weapon that allows the investor to control their timing, rather than being controlled by the market's volatile momentum. The analytical demonstration of the necessity of liquidity centers on its crucial function as a crisis fund, an accessible pool of dry powder. Liquidity allows the investor to act immediately and decisively when the rare, deep value opportunities, created by a violent selling climax, Rule 2, finally appear. These opportunities are notoriously fleeting, often lasting only days or weeks, and require the immediate deployment of significant, unencumbered capital to capture them fully. Without readily accessible cash, the investor would be forced to sell existing, potentially undervalued positions at fire sale prices just to raise capital for the new, superior opportunity, incurring massive transaction costs and opportunity loss. Levy highlighted through countless historical examples that the greatest, most asymmetric returns are often generated by purchasing assets from forced sellers during maximum systemic distress. However, only investors holding sufficient, readily available cash can effectively participate in this immense transfer of wealth from weak hands to strong, disciplined hands. The crisis fund ensures that the investor can capitalize on the market's severe psychological errors without incurring the high transaction costs and opportunity loss of liquidating other parts of the portfolio prematurely. Cash, therefore, is the essential dry powder necessary to capitalize powerfully on systemic instability and panic. Levy's rejection of the institutional dogma requiring funds to remain fully invested at all times was a defining, contrarian feature of his management style. He recognized that high valuations, coupled with overly positive, saturated narratives, Rule 1, often signaled protracted periods where expected future returns would be minimal or even negative, making cash the demonstrably superior asset class. Illustrating this point, Holding cash during the later speculative stages of the dot-com bubble, while seemingly underperforming the index, preserved massive buying power that became immensely valuable when the bubble inevitably burst in 2000 and 2001. Preserving capital systematically during bubble periods maximizes buying power for the eventual painful downturn, thereby amplifying the returns achieved when that capital is finally deployed strategically. Levy emphasized that the opportunity cost of temporarily holding cash is manageable and predictable, but the cost of being forced to sell during a crisis due to leverage or illiquidity is often catastrophic and permanent. This rule transforms cash from a lazy passive asset into an active strategic position specifically designed to optimize future deployment and maximize optionality. The pressure to remain fully invested introduces significant structural risk into any portfolio, often forcing managers to purchase marginal, expensive assets simply to utilize the available capital. Levy argued convincingly that this institutional mandate is fundamentally antithetical to true long-term value creation and capital preservation. If rigorous analysis confirms that no genuinely attractive asymmetrical opportunities exist in the market, the only rational disciplined decision is to hold cash, consciously accepting short-term tracking error relative to the benchmark for long-term safety and superior crisis-driven returns. Furthermore, liquidity provides an unparalleled psychological freedom that leveraged, fully invested investors lack entirely. When market participants are highly leveraged and fully invested, they are structurally susceptible to emotional swings and are forced to react defensively to volatility, often selling at the worst time. The highly liquid investor, conversely, can observe the market panic from a secure position of financial strength, allowing for cold, rational, and pre-planned decision-making during moments of extreme volatility and stress. Rule 4 is the ultimate practical expression of patience, discipline, and preparedness in a perpetually impatient, volatile market environment. The fifth and final golden rule demands concentrating capital on a small number of complex, high-conviction ideas where the potential upside significantly outweighs the potential downside. This is the relentless search for asymmetry, the investment profile where, if the core thesis is wrong, the capital loss is limited and controlled, but if the idea is correct, the return is multiplicative and nonlinear. Levy was fundamentally an opportunistic investor, believing that true, powerful asymmetry rarely resides in widely followed, highly efficient blue-chip stocks. He focused his considerable analytical resources on situations of overlooked value, opportunities that were too complex, too unpopular, or too structurally unique for traditional, momentum-driven analysts to properly value. This often involved moving aggressively into specialized areas like distressed debt, complex regulatory situations, or corporate spin-offs where the required deep research effort and analytical difficulty deterred the vast majority of mainstream investors. The ultimate goal was to find profound value hidden behind layers of institutional inertia or analytical complexity. Identifying investments with a truly asymmetrical profile requires looking for situations defined by structural changes, complex regulatory environments, or deep mispricing caused by forced selling, the natural outcome of Rule 2. These are not simple price-to-earnings ratios plays. They are complex, high-conviction bets on a specific future outcome that is demonstrably not reflected in the current market price. For example, Levy might analyze a company undergoing a major, poorly understood corporate restructuring, where the sum of the value of the component parts is significantly greater than the market capitalization of the whole combined entity. The key to achieving asymmetry is the rigorous establishment of limited downside risk. If the maximum potential loss is calculated to be 10%, but the potential gain is realistically modeled at 200% or more, the investment meets the asymmetrical criteria, regardless of the temporary perceived risk or volatility. Levy often utilized complex securities, such as carefully selected convertible bonds or warrants, which offered a measure of downside protection while providing full exposure to the massive upside potential of the underlying equity. This sophisticated approach minimized the risk of permanent capital impairment while maximizing the potential capture of systemic mispricing. The data-driven explanation of this concentrated approach demonstrates how it minimizes the overall number of investment decisions while simultaneously maximizing the impact of the correct ones, providing a demonstrably superior long-term return profile. Traditional excessive diversification attempts primarily to minimize short-term volatility, but often critically dilutes long-term returns by forcing the investor to hold many mediocre ideas. Levy preferred to concentrate capital heavily in his best 5 to 10 high-conviction ideas, consciously accepting higher short-term volatility in exchange for the potential for massive, asymmetric outperformance. This concentration strategy is intrinsically linked to robust, intensive risk management practices. Because the investor maintains fewer overall positions, they can dedicate significantly more time and intellectual rigor to understanding every single facet of those specific concentrated bets, including modeling all potential failure scenarios. This deep, high-conviction analysis drastically reduces the probability of catastrophic unforeseen losses. Levy's system demands that the disciplined investor only swings at pitches they know they can hit out of the park, ignoring the vast majority of marginal opportunities. True asymmetrical value is rarely easy to find or simple to explain to a broad audience. If the investment thesis can be accurately summarized in a single, simple headline, it is highly likely that the value is already fully priced into the market. Levy sought situations where the inherent complexity acted as a natural deterrent, effectively creating an analytical moat around the opportunity that kept mainstream capital out. This might involve deeply understanding obscure tax law changes, accurately anticipating the outcome of specific, complex litigation, or mastering the highly technical mechanics of a niche industry undergoing structural change. This rule requires immense intellectual humility combined with a willingness to specialize deeply. The investor must be confident enough in their unique proprietary insight to deploy significant capital, yet humble enough to recognize the extremely limited number of truly great, asymmetrical opportunities available at any given time. By focusing relentlessly only on the big idea, the investor avoids the pervasive temptation of chasing marginal opportunities that offer fundamentally poor risk-reward trade-offs and dilute concentration. The genius of Leon Levy's philosophy lies not in the power of any single rule, but in how the 5 rules interlock seamlessly to form a coherent, dynamic, and highly effective investment system. The integrated process begins systematically with Rule 3. Macro context dictates the global economic environment and determines the appropriate asset allocation strategy for the current cycle. This macro analysis leads directly to Rule 4. Liquidity positioning, ensuring the investor has the necessary dry powder prepared for crisis. This liquid capital then patiently waits for the precise behavioral trigger defined by Rule 2, the selling climax, the moment of maximum emotional panic and capitulation. When the climax violently arrives, the investor deploys capital into opportunities identified by Rule 5. Seeking asymmetry, which are inherently Rule 1 defying, meaning they are fundamentally undervalued precisely because they stand outside the dominant, failing market narrative. This integrated framework dynamically moves the investor through the entire market cycle, from rigorous analysis and preparation to precise timing and decisive execution. It is a system specifically designed to exploit the predictable psychological errors of the masses within the context of inevitable recurring economic cycles. A final analytical comparison clearly contrasts Levy's dynamic, behavioral macro approach with the static, traditional Benjamin Graham style of fundamental value investing. Graham focused meticulously on buying companies trading far below intrinsic value based on verifiable conservative balance sheet metrics, such as net current assets or low price-to-earnings ratios. This classic approach is highly effective and safe in stable, rational markets, but often struggles immensely during periods of extreme behavioral bubbles or systemic, disruptive macro shifts. Levy's approach conversely accepts that intrinsic value is difficult to measure precisely and is highly dynamic, often shifting dramatically based on central bank interest rates and structural inflation. Rule 3. He prioritized timing and market psychology over static metrics, viewing the market as a psychological mechanism prone to extreme violent swings, rather than a perfectly rational weighing machine. While Graham provides the essential foundation for finding deep value, Levy provides the dynamic, behavioral strategy for capturing that value at the optimal, crisis-driven moment, using macro forecasts and psychological triggers to achieve superior returns. Incorporating Levy's 5 golden rules into current portfolio management requires a fundamental and difficult shift in perspective away from fear of missing out, index hugging, and constant unnecessary activity. Practical steps include dedicating significant, consistent time to analyzing global monetary policy and long-term inflation trends, understanding the true cost of capital. Rule 3. Investors must also commit to holding substantial strategic cash reserves during periods of market exuberance, consciously avoiding the pervasive institutional pressure to remain fully invested. Rule 4. Crucially, investors must train themselves intellectually to identify and resist the dominant market narrative. Rule 1. Actively seeking out contrary opinions and assets that are fundamentally disliked or ignored by the consensus. Furthermore, the investor must rigorously predefine the behavioral indicators of a genuine selling climax. Rule 2. And prepare a detailed prioritized list of high-conviction, asymmetrical ideas. Rule 5. To deploy capital instantly when market panic strikes. This disciplined, integrated behavioral macro approach is the ultimate pathway to truly beating the market consistently over the long term. Applying Levy's comprehensive framework requires immense intellectual independence, which is perhaps the hardest investment trait to cultivate successfully in a consensus-driven world. The investor must be psychologically willing to look foolish for extended periods, holding significant cash while others profit, or buying large blocks of assets when the financial news is overwhelmingly and universally negative. This requires moving beyond short-term quarterly performance metrics and adopting a multi-year, deep cyclical view of capital deployment and market dynamics. Levy's enduring legacy is a powerful testament to the efficacy of combining rigorous quantitative analysis with deep, actionable psychological insight into market mechanics. He proved through decades of superior returns that the greatest persistent source of market inefficiency is not informational asymmetry, but behavioral asymmetry. The predictable, recurring tendency of human investors to overreact violently to both euphoria and fear. By mastering and integrating these 5 golden rules, any serious investor can build a robust framework designed to profit systematically from the extremes of the market cycle, moving beyond mere survival toward consistent, market-beating success. Now that we have covered the entire integrated system developed by Levy, we return to the essential action that sustains this channel and allows us to continue providing this level of analytical depth. If you found Levy's systematic approach valuable, please subscribe now and leave a comment below. Remember, especially during challenging times when trading becomes difficult and your confidence starts to waver, this channel and this community are here as a resource. Your subscription and comment are the simple actions that ensure this resource remains viable, helping us reach those who need guidance most when the market tests their resolve. This dynamic, contrarian system provides the necessary roadmap. It forces investors to think independently. It demands patience and discipline. It defines the path to superior long-term returns.